We have all felt the effects of inflation this year, and in a way that we have not in an exceptionally long time. As part of its mandate to keep prices stable, the Federal Reserve has been steadily raising interest rates all year. To most of us, the effects of rising interest rates show up most in the housing market. Mortgages have certainly become more expensive this year. However, rising interest rates can affect your retirement beyond just housing. I'm Daxton Fryer, part of the All-Star Advisor team here at Roberts Wealth Management. Here are 5 ways that rising rates may affect your retirement plan. And be sure to watch until the very end where I discuss the big one, your investments. More and more people in the U.S. have started leaning on their credit cards to make ends meet. Unfortunately, rising interest rates also mean that borrowing costs for credit card holders are going up too. If you carry a balance on your cards or occasionally use one to carry an unexpected expense, your monthly interest costs will increase as rates go up. Card rates are at a record high, with the national average coming in at around 19%. When we think about credit card rates in the larger economic picture, we see that Americans' revolving debt continues to hit all-time highs. Albeit at a slowing rate, this tends to suggest that U.S. consumers are starting to tap out. This will certainly cool demand, especially as borrowing costs rise. Rising interest rates will also increase borrowing costs for HELOCs. A financial planning hack has been to set up a home equity line of credit in lieu of a traditional emergency fund. After all, it is a lower interest rate option than a credit card, plus it is secured by an asset. So it is not a bad strategy. However, rising interest rates will increase the borrowing costs associated with HELOCs too. So that emergency fund could become much more expensive to maintain. And let us not forget that banks closed out HELOCs with a zero balance during the great financial crisis. So this strategy is not foolproof. Another way that rising interest rates will affect your retirement is housing costs. We all know that mortgages are much more expensive than they were even just a year ago. In some cases, they have forced potential buyers out of the market entirely. If downsizing to a new home before or during retirement is part of your plan, then higher rates will increase your borrowing costs. Now, hopefully, you will not need to get a mortgage as part of your downsizing. Rising mortgage rates have already cooled the housing market significantly this year, and there may still be further drops in the prices to come. Unfortunately, cars do not last forever. If you will need to replace cars in retirement and you cannot pay entirely with cash, then these purchases will become much more expensive with rising interest rates. There is one thing to note here. With all these expenses I have mentioned, whether it's a mortgage, credit card interest, HELOC interest, or car note, these are all recurring expenses. Now, recurring expenses are the #1 factor that can make or break your chances of a successful retirement. If you are not debt-free, rising interest rates will undoubtedly create additional stress on your retirement. Up until this point, seeing the effects of rising interest rates has been straightforward. However, they do impact on your investments as well, and not necessarily for the better. Rising interest rates have a direct effect on the bonds in your portfolio. Bond values move in the opposite direction of interest rates. This is called interest rate risk. As rates rise, bonds decline in value. As we have seen this year, I am not sure that everyone appreciated how much the safe investments in your portfolio could drop in such a short time. That is why it is important to choose bonds with shorter durations. The shorter the duration, the less they will be affected by interest rate movements. The positive aspect for bonds is that investors will finally start seeing some yield. While bonds are simple enough, rising interest rates affect stocks in multiple ways. First, the companies you are investing in will now have higher borrowing costs, just like the rest of us, which compresses their margins. The cost of inputs for these companies have increased with inflation too. Not only have the cost of goods sold increased, but labor and salaries have gone up as well. Currently, low employment for the moment has driven up labor costs. All of this points to a more challenging environment for most companies to be successful. Lower expected profits and dividends would naturally lead to low stock prices. As retirement portfolios feel the effects of rising interest rates, we might see our sustainable retirement withdrawals get cut. Remember that sequence risk? The order of investment returns that you see in the first few years of retirement will affect how much you can pay yourself later in life. Even if the average return is the same, the order still matters. While inflation is not doing us any favors, we can still do our best to manage it. I do not expect that we will continue to see raging inflation like this for years and years. At some point, the pain will become too great and demand will completely dry up. And that is the point of all of this. If one of the Fed's mandates is for price stability, the big lever they must pull to tame inflation is rising rates. Higher rates squelch demand. So when pundits and politicians bleat about the Fed killing the economy by raising rates, they're right. That is the only option that the Fed has. Thank you for joining us today. If you have any topics you'd like us to cover or any questions for us, please email us at info@robertswealth.com because we always want to know what you think. And if you find these videos helpful, please be sure to like and subscribe to our Retire Right YouTube channel. There you'll find our video library where you can watch content on several financial topics. By liking and subscribing, you'll also be the first to receive updates when we release new videos.